Today's highlights: Bitcoin has pulled back by 14.94% and systemic funds are all missing. The escalation of the Middle East conflict is actually a game over the Federal Reserve's liquidity. Stoke Company is facing dual pressures from interest rates and regulations. How the crypto market can truly break through and reverse the situation remains a question. March 2nd, Monday, this is the BitcoinTV Chinese channel. Where is Bitcoin? I'm Michael. Let's take a look at the most important data from the crypto world over the past 24 hours. Over the past week, today is Monday, 8 a.m., we released an exclusive weekly review for our members, summarizing which coins are currently good for bottom fishing and at what price level you can start buying Bitcoin as it drops. In February, Bitcoin fell by 15% for the entire month. Actually, this wasn't a sudden reversal, it's just that the money didn't keep up. Looking at the SOPR data, it's been below 1 for a while, which means quite a few people are selling at a loss, even with tears in their eyes. Meanwhile, new funds haven't come in to fill the gap, so you can see the Coinbase premium fluctuating between positive and negative. The spot buying power in the US isn't strong enough either. On the futures side, leverage is already being unwound, and open interest keeps dropping. In this relatively illiquid environment, even a small amount of capital can push the price up or down dramatically. Sentiment is extremely fearful, but there aren't actually many spot holders willing to catch the falling knife. Many of the rebounds are just short sellers covering their own positions. So when the US dollar strengthens, risk assets come under pressure. At this point, Bitcoin looks more like a high beta stock rather than a safe haven asset like gold, right? ETF inflows are sometimes incremental, and sometimes they're just people cashing out, so the growth of stablecoins also appears sluggish. Since no one is fully loaded with positions, the market naturally can't go very high or very far. So ultimately, this round of decline is a structural issue, not just an emotional drama. If we want to see a plot twist, it will only start when real money comes back into the market to take positions. Let's rewind a bit and look at how Bitcoin reacted during the start of the Russia-Ukraine war in 2022, the Israel-Hamas conflict in 2023, and now as the Israel-Iran war escalates in 2025. The response has been almost a copy-paste each time. In the first few days after the fighting started, there was a sharp increase in net inflows to exchanges, as everyone was busy adjusting their portfolios and seeking safe havens. But a few weeks later, or 3 months later, the data returned to normal, and there was no sustained capital flight. Why is that? It's very simple. Bitcoin keeps producing blocks. It doesn't care about war reports, and the network doesn't stop producing blocks because of war. Moreover, institutional funds in ETFs now account for a very high proportion. So many conflicts are already fully hedged in the secondary market and derivatives market. There won't be constant sell-offs in the spot market. To put it plainly, what is war like? It's like a gust of wind that makes prices sway for a moment. But what truly determines the direction of prices is still the level of US dollar liquidity, the tightness of interest rate differentials, and the expansion speed of stablecoins. History has repeatedly proven one thing: artillery and war can create volatility, but it's liquidity that determines the trend. Alright, let's take a look at this set of unusual activity monitoring data from Binance. Bitcoin is actually behaving very steadily right now. The 24-hour MA deviation is negative 0.079. What does that mean? Basically, it's moving right along the moving average, without any sudden erratic deviations. The 24-hour standard deviation is 0.611, which means the volatility is slightly higher than before, but it's still not at a level where the market is out of control. The z-score is only 0.315, still quite a ways from the standard deviation of 1, so it's neither overbought nor oversold. In fact, it just means that no one really has much enthusiasm for trading right now. The price fluctuation is only 0.11%, which is almost like standing still. So the price keeps bouncing back and forth between 63,500 and 67,200, and as for the z-score, sometimes it's positive, sometimes it's negative. It's like every time a trend starts to form, it gets pulled back, and whenever it starts to drop, it gets yanked back up. Therefore, only when volatility continues to increase and the z-score breaks above 1 will the market truly pick a direction. Before that happens, it's highly likely that the price will just keep moving back and forth within this range, testing everyone's patience. At what price level can we start buying Bitcoin on the way down as it drops? Please refer to the exclusive services for Royal Gold members. Alright, please like this video and turn on the notification bell. We're here to help you sort through what's happening in the crypto world, blockchain world, and mining world over the past 24 hours, focusing on the things that matter most to your wallet. Our hope is that this kind of news summary from a macro perspective will help you as you enter Web 3 or even the new concept of Web 4 to understand what rapid developments might emerge when AI is combined with crypto. Now, let's get started with our channel's signature segment, Lobster. As for our channel's Lobster segment, so far, its contract trades on OK have maintained a 100% win rate, with an annualized return rate reaching 26%. Of course, it's still in the testing phase, and just the API data we've fed, it is worth no less than $100,000. Raising a lobster is cheap, but what it eats to grow, that's the key, right? And more importantly, we want to use this kind of testing to see to what extent this AI can solve some of our pain points in contracts or in content and news coverage, whether it can bring us even closer to the actual news events. We've spent 6 years reducing the time lag between our news and our broadcast from 4 hours. Can we shorten it to 0 lag or just a 1 hour lag? That's our goal. All right, let's take a look. Right now, the hottest topic is, of course, that the United States has launched a major military operation against Iran called Operation Epic Fury, right? Just from the name, you can tell this isn't a game. Tensions in the Middle East have instantly reached a boiling point. Yesterday, when I was chatting with some friends at Binance, they said, let's not talk about business for now. Let's just hope we all stay safe.
Arthur Hayes, co-founder of BitMEX and CEO of Max Fund, believes that if the war drags on and U.S. fiscal pressures increase, the Federal Reserve may be forced to cut interest rates or restart quantitative easing. The real window for heavy investment comes when policy clearly shifts and liquidity is confirmed to have returned. War is a catalyst, but liquidity is the true driving variable.
I think the market in general has been down due to geopolitical uncertainty and news about tariffs and similar issues. So Bitcoin has followed that trend. I think in the short term, Bitcoin moves in line with the market. In the long term, it's basically uncorrelated. So I think it's just a matter of taking a longer term perspective.
During traditional market closures, on-chain prediction and derivatives platform activity has risen significantly. Public data shows that over $500 million have flowed into platforms like Polymarket and Kalshi to bet on the Middle East situation. Open interest in hyperliquid crude oil contracts has reached a new stage high. At the same time, reports indicate that 6 new accounts established long positions before the airstrike and profited over $1 million, drawing regulatory attention.
When Israel and the United States fired the first shells at Iran, Bitcoin surged with a strong green candle, a breakout with high volume on the 4-hour chart, right? It's simple. If everyone expects the war to escalate and spending to spiral out of control, what comes to mind is that the money printers will start warming up. It's very likely that the Federal Reserve would be the first to step in and begin quantitative easing. Of course, all business and the entire global financial market are now watching the Federal Reserve's press conferences, paying attention to the Fed's every move. Before Powell utters the words, "We have decided to," all the volatility is just a rehearsal, war included. That's why American companies that are listed and regulated have a certain level of credibility, because all their documents and contract information are made public. As everyone knows, Circle is the parent company of USDC. Its current asset reserves amount to $76.5 billion, with 93% allocated to overnight repurchase agreements and short-term US Treasury bonds. So how does it cooperate with Coinbase? As you know, Coinbase only uses USDC for transactions, right? On the Coinbase platform, the interest from USDC reserves belongs to Coinbase, while the platform's profits are split equally between the two parties. However, if the Genius Act is passed, the profit distribution between the two parties may undergo structural changes.
Currently, Circle's reserve assets are about $76.5 billion, with 93% allocated to overnight repurchase agreements and short-term US Treasury bonds managed by a fund under BlackRock. The core profit model is to earn the interest spread from the reserves. According to the agreement with Coinbase, the interest from USDC reserves within the Coinbase platform belongs entirely to Coinbase, while the earnings from outside the platform are split equally between both parties. The regulatory draft under the framework of the Genius Act may affect this profit-sharing structure.
The numbers tell us an interesting story, which is that we saw, for example, the amount of on-chain transactions with USDC grow over 250% to about $12 trillion in the quarter. Incredible. And what we've also seen is that this is really a durable network effect business, and there's a couple of players, and that has consolidated. In fact, if you look at transactions happening, Visa measures this. We are now about 50% of all transactions. That's up from just over a third in the prior quarter, and the collected amount of transactions from all the other stable coins that have launched is basically rounds to zero.
So if we piece together all this news, in short, Circle is a money printing machine driven by interest rates. However, if this bill passes, the switch will no longer be in their own hands. First, the so-called Genius Act will come into play, and how the revenue is split between them and Coinbase is still unknown. Second, and more importantly, interest rates are falling. The Federal Reserve interest rate has dropped from 4.49% to 3.81%, a decrease of 68 basis points. If Circle's supply hadn't increased by 72% year on year to offset the thinning profits, its operations might have run into trouble. However, fortunately, during the same period, the supply of USDC increased by 72%, which temporarily offset the issue of shrinking interest rates by scaling up. But if growth slows down and interest rates continue to fall, profits could be squeezed from both sides. Circle has already proven that stablecoins are not just a supporting role in crypto, but rather an on-chain extension of the US dollar. So, how far it can go in the next 10 years depends on two things: how much interest it can offer, and whether USDC's scale can surpass USDT. AI is making a direct impact on Web3. Developers, researchers, and customer service positions are all facing layoffs. Is AI really coming to take our jobs? X has relaxed its policies on crypto promotion. Can X Money, Musk's super financial app, turn its dream into reality? In the past 2 weeks, CTOs and so-called core AI management positions at major companies have all written very emotional resignation letters. Many big names have left. Why is that? They predict that in another 6 months, AI will enter a phase of recursive evolution, advancing at a speed that surpasses the human brain, learning even faster. And once one AI agent masters something, all agents can instantly replicate and acquire that knowledge. Jobs like surgical operations, translation, legal consulting, and data analysis may no longer require humans. So, as you can see, AI is increasingly encroaching on our employment system, our skill system, and even our cognitive system. Over the past 2 weeks, many things I once considered valuable have been collapsing. You could say it's a process of breaking down and rebuilding my worldview.
When it comes to specific job positions, the changes are already very real. Entry-level Solidity developers, researchers, data analysts, and community customer service roles are being rapidly replaced by large models and agents. In areas like high-frequency trading and arbitrage, which used to be the domain of top experts, the advantage of algorithms is absolutely overwhelming.
I think the message is nascent but clear that AI is starting to have an impact. I think the first phase of this was a lowering of hiring rates in the second phase, and we're seeing that in some of these anecdotes. And I wouldn't ignore anecdotes entirely. You want to have data to back it up, but the anecdotes are pointing towards the next phase, which is going to be some sporadic layoffs. And so, yes, I think it's absolutely a big deal.
The sentiment in the industry is shifting. The founder of OpenCLO publicly advised young people to be cautious about entering the crypto sector, sparking widespread discussion. Some crypto professionals are turning to AI startups or the content sector, with several project executives and investors announcing their transitions. Paradigm, known for its crypto-native focus, has already begun planning an AI fund. Data shows that the number of crypto market financings has dropped significantly compared to 4 years ago, the number of early-stage projects has decreased, and opportunities for newcomers have clearly contracted.
Take our own channel as an example. With all the different minor languages, editors, and post-production staff, if we fully adopt AI, we could lay off at least half of our team. But then the question arises, what happens to those people who are laid off? AI doesn't buy cars, bread, or milk. It doesn't fly on planes or book hotels. It doesn't consume anything, right? If the unemployment rate is rising while consumption is falling, then how is the real economy supposed to sustain itself? This is a deeply conflicting issue that has always troubled me. You might say I'm worrying too much, but these are real things happening around us that directly affect our lives. We may not understand economics or the rules or the cycles, but everyone knows the basic principle that people earn wages and spend money to drive the economy, right? So what is the real question here? What should be automated and what should be left to human judgment? Perhaps the combination of crypto and AI is not the endpoint, and AI is not some enemy that will replace everyone. So, in this era, or rather, where is the cognitive watershed? It comes down to whether you agree with human-machine collaboration. At this point, you simply can't do without AI anymore. So, take a look. Do you have your own intelligent agent in your hands? After thinking it over, what is it that AI truly cannot replace? My face, our content, our organization, all of our news output, these can all be replaced by AI using workflows. But for now, our traffic is something AI can't replace, especially in the Web3 space, right? As you can see, on one hand, global regulations are getting stricter, and every social platform and traffic platform is afraid of stepping on landmines, so they're quick to ban all kinds of ads and restrict traffic, tagging your content. Especially if you look at the UK and places like the EU, their regulations are extremely strict. As long as your content mentions any kind of financial return or token promotion, it's very easy to get flagged by regulators. That's why Twitter, as the most active public opinion platform in the crypto space right now, has been constantly pulled back and forth between traffic and compliance over the past few years. To put it bluntly, Twitter wants to have it both ways. They want to keep their traffic, maintain the enthusiasm of ecosystem creators, and at the same time avoid getting into trouble over advertising. But recently, Twitter's attitude has clearly changed, and they decisively updated their labeling policy.
On Sunday, X updated its policy, officially lifting restrictions on crypto and gambling promotions, and now allows crypto content with paid partnership labels to be posted. Commercial partnerships must be clearly disclosed and comply with the platform's new paid partnership framework. But in highly regulated regions such as the EU, UK, and Australia, related content may still face display restrictions. The platform emphasizes that violations can be reported, and adult content, alcohol, prescription drugs, weapons, and political commercial promotions remain strictly prohibited.
Essentially, if done right, X would serve people's financial needs to such an extent that over time it could become, I don't know, maybe half of the global financial system or some other huge figure. I'm not sure what the exact number would be, but it would be pretty big. It would be by far the largest kind of financial institution, but as I said, not really in the way people are used to thinking about banks.
At the same time, on February 11th, Elon Musk stated that X Money would begin testing within 2 months, and on February 14th, he revealed the Smart Cash Tag plan, which may support stock and crypto asset trading on the platform in the future.
In my opinion, Twitter, now X, the content on there is already absolutely wild. Come on, don't pretend. How many of you have alternate accounts just to watch adult content on Twitter, right? So this time, X relaxing restrictions on crypto promotions is actually more than just a signal. Behind it lies a grand strategy for building a financial ecosystem. It really is a big move. On one hand, it allows creators to earn money legally. On the other hand, it's moving towards payments, transactions, and financial services. It's obvious that X is aiming to become an application ecosystem. Looking ahead, just imagine. If X can be integrated with X Money and support payments, then it won't just be a place to talk about crypto prices. It will become a platform where transactions can be completed directly, creating a real barrier to entry. Of course, it's not easy to get past European regulations right now, but the trend is already very clear. If Twitter wants to keep its traffic, content, and money all within its own ecosystem, whether it can ultimately succeed will depend on its execution and compliance capabilities. But I believe that with enough money, anything can be done. All right, let's look at the news highlights.
In the past 4 months, Bitcoin and Ethereum ETFs have seen a combined net outflow of over $9 billion, setting a record for the largest withdrawal during this period in history. Institutions that once scrambled to buy in are now voting with their feet. Institutions may be pulling out their positions, but they can't withdraw the Bitcoin itself. Still, this signal is worth taking seriously. Strategy has posted monthly losses for 8 consecutive months, but that hasn't stopped Michael Saylor from raising the annual dividend on XGRC preferred shares from 11.25% to 11.5%. Holding onto a pile of unrealized losses while maintaining a calm, unwavering stance about not selling, this is the pure classic Saylor style. SpaceX holds about 8,285 bitcoins, with their market value shrinking from $780 million to around $545 million, a paper loss of $235 million in just 3 months. That doesn't look great on the books right before the IPO. Everyone says Bitcoin is bullish in the long run, but having this kind of risk exposure right before going public is definitely a bit of a hot potato. The latest research report from JP Morgan points out that once the Clarity Act is passed, it will bring regulatory certainty, drive large-scale institutional entry, and accelerate the tokenization process of the US crypto market. Even more crucial than the bill's passage is that the market has already started pricing in this expectation ahead of time. After the sharp drop caused by the war, the crypto market staged a strong recovery. Ethereum climbed back above $2,000, Solana surged as much as 10.8% in a single day, and XRP also bounced back. Panic has subsided, but key technical resistance levels have yet to be broken. The rebound is real, but for a confirmed trend, we still need a bit more momentum.
All right, now that we have AI and deafblind intelligent agents, our channel has already started experimenting with contract copy trading. You have to understand, once the market enters a highly volatile phase, many people's first reaction isn't to reduce risk, but to increase leverage. That's a recipe for disaster. They think bigger swings mean more chances to make money, but in reality, it's just the opposite. You should know, the greater the volatility, the easier it is to make mistakes in judgment, and your returns could easily turn negative. When market sentiment is uncertain, both bulls and bears will swing back and forth, creating a very typical structure of two-way liquidation, where both long and short positions get wiped out. That's why only AI agents, which can watch every risky fluctuation 24 hours a day without sleeping or blinking, can help you monitor the market. Only in this way can we rely on AI to survive in the world of contracts. You should know that a single misjudgment of direction in spot trading only results in a drawdown, but in contracts, it can knock you out completely. So true trading skill isn't about how much you're willing to bet, but whether you can survive while managing your exposure in this uncertainty. That's why, when it comes to contracts, any trading strategy, no matter the theory or style, is worthless in the face of back-end data. In the contract market, simply surviving for a long time is itself a crucial advantage. All right, that's all for today's program. If you're interested in contract copy trading and want to experience what a 20% monthly return feels like, you're welcome to find us at OK and follow BTV Michael. We also hope you'll join our membership. Check out these membership benefits. Let's grow our wealth together. See you tomorrow.